Have you ever been afraid to take a promotion or earn extra money because you thought it would push you into a higher tax bracket and make you lose money? If so, you're not alone. It's one of the biggest and most expensive myths in personal finance. But here's the truth, that's not how taxes work at all. And this one misunderstanding could be costing you thousands of dollars, holding you back from promotions, and stopping you from starting that side hustle you've been dreaming of. Today we're going to demystify US tax brackets once and for all. I'll show you exactly how they work, why you're probably paying way less in taxes than you think, and how a simple shift in understanding can put more money back in your pocket. By the end of this video, you'll be able to confidently take that raise, start that business, and make financial decisions without the fear of being penalized by the taxman. First things first, the United States uses what's called a progressive tax system. That sounds complicated, but the idea is simple. Not every dollar you earn is taxed at the same rate. Instead, your income is sliced into different chunks, and each chunk is taxed at a different rate. Think of it like a stack of buckets. You fill the first bucket with your first chunk of income, and that bucket has a very low tax rate, say 10%. Once that bucket is full, the next chunk of your income spills into the next bucket, which has a slightly higher tax rate, maybe 12%, and so on. No matter how much you earn, only the money that lands in a specific bucket gets taxed at that bucket's rate. Your entire income is never ever taxed at your highest rate. Let's look at how this works in practice for a single person filing taxes in the US. The IRS adjusts the exact income levels each year, but the bracket percentages stay pretty consistent. For 2024, the first chunk of your income, up to about $11,600, is taxed at just 10%. The next chunk, up to about $47,000, is taxed at 12%. Then the next chunk, up to about $100,000, is taxed at 22%. And after that, you have brackets for 24%, 32%, 32%, 35%, and finally, the top rate of 37%. Now, here is the crucial part that most people get wrong. Let's say the 24% tax bracket starts at an income of roughly $100,000. If you earn $101,000, do you pay 24% on all of it? Absolutely not. Only that extra $1,000, the money that actually falls into the 24% bracket, is taxed at that rate. Everything you earned up to that point is still taxed at the lower rates of 10%, 12%, and 22%. Moving up a tax bracket only ever increases the tax on your additional earnings. It never increases the tax on the money you've already made. So, getting a raise will always mean you take home more money, period. Let's stop for a moment and let that sink in. Getting a raise is always a good thing. Don't let tax fear hold you back. This is why your tax bracket is not your tax rate. This leads to two very important terms you need to know: your marginal tax rate and your effective tax rate. Your marginal tax rate is simply the rate of the highest tax bracket your income falls into. So in our example, the person earning $101,000 has a marginal tax rate of 24%, but that's not what they actually pay overall. Your effective tax rate is what you really pay. It's your total tax bill divided by your total income. For most people, their effective tax rate is way lower than their marginal rate. Someone in the 22% bracket might only have an effective tax rate of 15% or 16%. Let's run through a quick simplified example. Imagine you earn $60,000 a year. Your first $11,000 or so are taxed at 10%. That's a little over $1,000 in tax. Your next chunk of income, from $11,000 up to about $47,000, is taxed at 12%. And finally, the amount you earn from $47,000 up to $60,000 is taxed at 22%. When you add it all up, your total tax bill is much lower than if your entire $60,000 was taxed at 22%. Your highest bracket is 22%, but your real effective tax rate is closer to 14%. See the difference? Confusing these two is what causes all the panic. So now that we've busted the biggest tax myth, let's get to the fun part: how to use this knowledge to legally and ethically lower your tax bill. Understanding that your income is taxed in layers means your goal should be to reduce the amount of money that spills into your highest tax brackets. And there are some incredibly powerful ways to do that. The first and most effective strategy is to use tax-advantaged retirement accounts. Think of things like your 401k at work, a traditional IRA, or a health savings account, and when you contribute to these accounts, the government doesn't count that money as part of your taxable income for the year. The next powerful tool is deductions. Most people take the standard deduction, which is a set amount you can subtract from your income. But if you have enough specific expenses, you can itemize your deductions to save even more. Common deductions include mortgage interest, state and local property taxes, large charitable donations, and even student loan interest. Keeping track of these can easily push you over the standard deduction threshold and give you a bigger tax break. But here's a pro tip that can unlock a whole new world of deductions. Start a side hustle, even a small one. The US tax code is incredibly generous to business owners. Once you have a business, even if it's just a small freelance gig or an Etsy shop, you can start deducting business-related expenses. We're talking about a portion of your home office, your cell phone bill, your internet, business-related travel, software, supplies, and so much more. These deductions directly reduced your taxable income, pulling more money out of those higher brackets and keeping it in your pocket. Another strategy the wealthy use all the time is timing. You have more control than you think over when you receive income and when you incur expenses. For example, if you know you're getting a big bonus at the end of the year that will push you into a higher bracket, you might be able to ask your employer to pay it out in January instead. Or you could make a large charitable donation in a high-income year to get a bigger tax benefit. By strategically timing these events, you can smooth out your income across years and minimize the amount that gets taxed at your highest rates. And finally, it's crucial to understand that not all income is treated equally. The money you earn from your job is called ordinary income, and it's taxed using those brackets we just discussed. But income you earn from investments is often taxed differently. Specifically, long-term capital gains that profit from an investment you've held for more than a year are taxed at their own special, lower rates. For many Americans, that rate is 15%, and for some, it's even 0%. This is a huge advantage. It means that a dollar earned from a long-term investment can be much more valuable than a dollar earned from your salary after taxes. This is why building up an investment portfolio is not just a path to wealth, but a path to tax efficiency. So let's bring it all home. The single most important thing to remember is this: a promotion, a raise, or extra income will never cause you to take home less money. Moving into a higher tax bracket is a sign of financial success, not a penalty. It just means the new extra dollars you're earning will be taxed at a slightly higher rate. Once you truly understand that, the fear disappears and you can focus on what really matters: earning more, saving more, and using the rules of the tax system to your advantage. Max out those retirement accounts, explore deductions, consider starting that side hustle, and start investing for the long term. These are the foundational steps to building real, sustainable wealth. And it all starts with knowing how the system really works. Thanks for watching, and if you found this helpful, be sure to hit that subscribe button for more tips on how to manage your money and build a better financial future. See you next time.